Welcome back to Galaxy Grid. I'm Alex Thorne, head of firm-wide research at Galaxy, joined by Thaddeus Pinikavich, Lucas Chayan, and Zach Picorni from Galaxy Research. This is the show where we talk about all the biggest news in crypto from last week and what to watch in the week coming forward. This week, we're going to talk about, has Bitcoin bottomed? Are any of the gentlemen on this show willing to call a bottom? We will find out. We'll also talk about journalists yet again misrepresenting the amount of illicit activity on blockchains. And we'll talk about the Federal Reserve offering new guidance for its bank examiners, what that means in the context of Operation Choke Point 2.0 and for demand for U.S. Treasuries. Some other small topics. Solana has a new inflation reduction proposal out. Monad, the EVM-compatible Layer 1 blockchain, just went live today, November 24th. And Vector.fun was acquired by Coinbase. What does that mean, if anything? And before we get to any of that, I need to remind you to please refer to the link to the disclaimer in the show notes and note that none of the information in this show constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Well, if you look at the monthly chart, gentlemen, Bitcoin was down only, but it does appear to have finally stabilized above 80,000. It's around 86K as we talk. Is anyone here willing to say that 80 to 82 was the bottom?
I sure hope so. Things are looking a little rough on the macro side still. We still got, looks like a rate cut coming in for December. Odds are getting better and better, which means things are looking worse and worse.
Weren't the odds getting worse and worse? They were just recently getting worse and worse, but now they're getting better and better.
Yeah. The odds for a rate hike are up north of 60% for December now. So it's looking a little choppy. But the rate market is always
more volatile than the meme coin traders.
Yeah, exactly. The old pendulum just swings back and forth nonstop.
Really bad. It's a famous one they call the spaghetti chart, which is if you look at the historical Fed futures rates, it's a complete mess. It's not very predictive.
It's like in every direction. Every prediction's always been wrong, is what you're saying. Wait, so Thad, are you saying the risk of macro uncertainty means you're not ready yet to call a bottom?
I think not quite ready. We've seen some pretty paper hands from the U.S. session. We're seeing a lot of Bitcoin selling in the U.S. hours, and I think with things looking a little rough here, we might get some more selling out of the ETFs going into the end of the year, and then hopefully get a little bit of that Santa Claus bid at the end of the year for a nice kind of Christmas present. But I think we may touch kind of high 70s. It was a pretty sharp bounce off of the 81 area over the end of the week, over the weekend though. So there's a strong bid, but it's there's some tailwinds, headwinds on us.
Yeah, on the bullish side for me, I'd say like seeing 900 million plus in outflows is always like a positive, as ironic, like as much as that may sound weird, like it. And then I'm excited to see what the inflows are today. We'll know by the time this episode is out, but like there's definitely some demand when it came down into 80K. On the negative side for me, like I was watching CNBC on Friday and like they literally talked about Bitcoin in every single segment and like extensively. And I don't know, like when I talk to other people, they're like, that's a positive. But for me, it's like, I don't think that's a positive. Like, I don't think you want people to not have a lot of exposure and be so concerned about what's happening with Bitcoin. And so I'm kind of mixed. Like what I think is going to happen, because I've had all these TradFi people message me saying they're buying Bitcoin, is like, they're going to buy Bitcoin. We're going to have a nice little relief bounce. They're going to get euphoric and then it's just going to rip down in their faces. And so I'm a big advocate of nothing ever changes. Like I'm probably like a taboo 4-year cycle believer still, to be honest. And so I do think there's more pain in store, but I will just say I try to remain bullish all the time, even if I'm bearish. So, send it higher.
Just kind of gauging from the sentiment on Twitter, it's like slightly improved. Like people seem like less depressed, but consensus is still lower. Like I think having the bullish bias for at least like the next 3 to 6 months seems to be like counter consensus. But yeah, I would say the vibes on Twitter have been restored slightly. People have gotten a bit realer about the position we're in, and it's not just like full-blown meltdown, like freaking out. But yeah, consensus from a sentiment perspective still says we're going at least a little lower.
Yeah, it does seem a little tricky, and I would say I still think it's squishy. I mean, I would say a bullish target is no more than 120 for end of the year. Remember, we were asking if I was a dirty bear for saying that when we were at like 105 like a couple weeks ago. Now it looks like hopium. It does feel a lot squishier. That whole thing was predicated on the fact that we hold like 95 and 100, and of course we didn't. So I don't know. I agree. I think a relief rally. I mean, Bitcoin likes to find max pain here, and a little bit higher in the face of everyone who's bearish, and then lower in the face of the new entrants, I think would be a bit ugly. So maybe Bitcoin likes to be ugly. Yeah. All right. Well, let's move on. We have other stories to talk about, but everybody, if you're long, remember your long thesis, and also think about what BIMNet has. Nothing in my mind has been shaken by in the long thesis, and I will say also nothing about privacy, nothing about quantum, which have been big areas of FUD against Bitcoin over the last week or two. Scares me. Bitcoin's still much more private than people give it credit for, in my opinion. Also, quantum is not close, no matter, and most people say that. So I wouldn't stress too hard. Bitcoin's not going to accidentally, fail to upgrade in the face of an existential threat, people. So don't be too worried about that in the near term. That's my opinion. Let's move on, Lucas. You read this. There was this read. I mean, look, it's real data. This read like FUD from 2021, though. A news investigation conducted by the New York Times and the International Consortium of Investigative Journalists, the ICIJ, and presumably others, respectable journalists, and I want to make that clear. They did a great investigation a few years ago about that they called the FinCEN files, about how most suspicious activity reports SARS filed were never acted upon, and it was totally like sort of a useless paperwork exercise that doesn't actually stop illicit activity at TradFi companies. But now they've done an investigation, the ICIJ and the New York Times, saying that 28 billion, as much as, or at least as much as 28 billion in illicit funds were moved on public blockchains. First, over what time frame are they saying that? And two, like, what else did they say? Before we get in, you wrote a great rebuttal in our newsletter last week.
Yeah. The headline here is they're saying over the past 2 years, they've seen about 28 billion in illicit flows into sexes. Like they specifically, they say 8 sexes, but they specifically call out Binance, OKX, and Bybit. And as part of that, they also highlight that a lot of this activity comes from basically cash to crypto stores where you can kind of go in and transfer crypto and get cash immediately. And so it's very difficult to kind of trace. There's no KYC AML requirements there. They also document pretty extensively a lot of the scams that we've seen happen, whether that's pig butchering, which we've talked and written about before. So I agreed with you. It's definitely impressive reporting. I was listening to the head journalist talk on Friday about it, and he was not overly familiar with crypto. But I will say, he was like, listen, I own Ethereum. I think it's interesting. So I don't think they're super biased against crypto. I think what we think, or where we kind of think they fell short, is they don't really put it in context of what's happening in the broader financial rails when it comes to illicit activity. And so, what we talk about in this rebuttal is, if crypto had 28 billion in illicit crypto flows into exchanges, that represents like maybe 0.5% of total flows over the past 2 years, just looking at Bitcoin, ETH, USDC, and USDT. So it would be probably, a lot less if we included all tokens. And to put that in perspective, estimates for TradFi rails is that 2 to 5% of global GDP, which is like 800 billion to 2 trillion, is money laundering. And so I think like the takeaway for me, at least, is like, ultimately these are anywhere where you have the ability to like transfer value. People that are doing illicit activities are going to try and take advantage of it because they need that to run their businesses. And so crypto is not going to be immune from that, but where crypto can excel is that it does provide transparent rails, so you can better track and see how these flows are going. That doesn't always mean you're going to be able to stop them. Like it can be horrifying, even more horrifying for people to like watch in real time as their money leaves their wallet and goes somewhere else and they feel helpless. But it does mean that you can, if you implement the right controls and compliance measures on the off-ramping side, do a much better job of preventing this type of crime and illicit activity from happening.
Yeah, the context seems quite important, and it's interesting because these are the same folks who did that report I was talking about, the FinCEN files, where they basically broadly documented how banks would just file all of these SARS with FinCEN, but then continue to do the business, right? Do billions and billions of dollars of business, knowing that it was suspicious, but having covered their bases because the financial surveillance regime didn't actually require them to stop doing the business. It just required them to alert the government. And then they had interviewed some former FBI agents whose job it was to then prosecute based on those SARS. And they just came out and said, like, we never use these. We never prosecute them. We only use them, at scale when we're going after a target. We query to see if there've been any about them when we already have a different target, right? So the financial surveillance regime, quite ineffective for illicit activity in the traditional sense as well. The other question I had for you, Lucas, though, real quick, was it just that these were cash deposited from corner stores, or was there actually evidence of illicit activity?
They were able to track down and find a few examples of real illicit activity. But ultimately, yes, a lot of this stuff, it was kind of like matching different deposits with times where there had been hacks and stuff like that, and saying, it's highly likely that this was, these two transactions correspond. They identified accounts that had been set up a day before by, low income worker in developing countries that suddenly had, $10,000 deposited into it and withdrawn, and they had never had that type of money before.
I mean, also too, on the side of like the law enforcement side, like crypto gives tools to actually like take money back from these frauds where they previously couldn't. I mean, Tether's blocked several thousand addresses holding about $1.5 billion USDT, or without the ability to freeze and track these funds on chain, they'd just be in some cash warehouse somewhere. I mean, the scale really comes to mind. I think it was Pablo Escobar had like a $2 billion of losses every year from rats eating the cash and his from his empire. So he was operating tens of billions of dollars, just one criminal enterprise. It just gives an idea of part of the scale that is facilitated with greenbacks. That it's a bit harder to see. So it's always easier to point to this on-chain fraud flows just because it can be seen, but that's also the benefit of it. That data goes to law enforcement, and they can help track down bad guys with that.
The TradFi equivalent, they give you a range of 800 billion to 2 trillion, whereas the on-chain stuff is a bit more of a pointed estimate. But like Lucas, they said that they were able to track down like specific individuals. Like, how are they able to know that like some person in a developing country had a suspicious deposit when you just exist on chain? Like it's just kind of weird to me that like the people seem like crypto curious, but not like advanced at on-chain analytics. Like, how are they actually like digging this stuff up and claiming like, oh, this came from like a Bitcoin ATM in some random country? And like many of the Bitcoin ATMs and off ramps that are similar to that actually do implement KYC. Like if you walk up to one, at least in the US, like you need to submit like an ID of some sort. So it's not like these machines are just like totally like
Oh,
fraud
definitely.
machines.
No,
Yeah, that
yeah.
just seems like
Well, 100%. And like I said, I think some of it is circumstantial. They did enlist the help of, leading analytics firms like Chainalysis and things like that. And then they also, I think, brought in some outside experts. So, I think for anything like this, there's always going to be questions about the true accuracy of the numbers and what is considered illicit activity, et cetera. But, there's definitely some truth to the numbers they put forth. I think the final takeaway for me also is this: if you look at reports from leading firms like Chainalysis and such, like actually the amount of illicit activities on blockchains is going down over time as a percentage of total activity. And I think a big contributor to that going forward is that we are starting to see regulatory frameworks come into place that make it harder for people to use blockchains for illicit activity.
All right. Yeah, I think that is the main takeaway, is that it's going down in both real and relative terms over time, and it's significantly smaller than the traditional system, which doesn't make it okay when it happens, but it does. I think it is important context, so that you're not, alarmed by the $28 billion number. In fact, I think that doesn't even come close to the fines banks have paid for a regular amount of stuff over the last 15 to 20 years. So, okay, let's move on. Thaddeus, you wrote an interesting piece about the Federal Reserve putting out new supervisory principles for bank examiners that effectively loosen bank oversight. And I don't mean that in the potentially incendiary way it may sound, but you said it was designed to help banks focus on real risks and less on paperwork. And weird sort of signaling, but sort of give a little bit more clarity. What was this?
Yeah, absolutely. I mean, very always interesting parsing the stuff coming out of the Fed, bit thick. But yeah, no, it is a loosening of essentially bank regs here. Not in, like I said, a very incendiary way, but on the margin for things that are a bit of a pain. So the prior life for Galaxy used to be a bond trader at a bank, and there's essentially a process for the Fed. If you've done bad, they come in with a, hey, you got to clean up your act. This MRA, matter requiring attention process. It's essentially the cops coming in saying, you messed up here, you need to fix the process. It's been a pain historically to deal with, because they're like, okay, you come up with a process to kind of fix the error, whether it's bad KYC, AML setup, you got some risk management process, and you come back with your solution, and they just be like, no, that isn't good enough. You're like, oh, why? And they be like, we're not going to tell you. So it's historically been immensely frustrating of just coming up with solutions. The Fed examiners just saying, that's not good enough, not giving you any real hints about where to go. They changed it so essentially they have to tell you, this is the problem, here's an actionable solution you can do. And it gives the banks a lot more leeway to kind of deal with this, and clears a bunch of the regulatory hurdle. The thing that gets interesting for crypto, though, is this specific Federal Home Loan Bank section of this. So this is one of those kind of random parts of the government sponsored entity market. So it's supported, sort of supported by the government, not officially backed by the U.S. taxpayer, but these banks essentially. Community banks, when they're in times of stress, they'll be able to post mortgages, treasuries to them, and they get a loan back.
It's there to sort of backstop the mortgage lending industry, right? So it's really banks that offer mortgages can interact with the Federal Home Loan Bank, its branches, to get more liquidity.
Yeah, exactly. They're in all of the Fed regions. So there's the New York Federal Home Loan Bank, San Francisco, and it featured prominently in the 2023 failures of Silicon Valley Bank and Signature. They were essentially the lender of last resort there against their portfolio.
Yeah, and Silvergate, I should say. Silvergate had an FHLB loan that was conspicuously called, even though it's supposed to be there to provide liquidity, and it being called was one of the main reasons it lacked the liquidity to then continue as a going concern. And no one's really quite found out why it was called. But what does this say about the FHLB stuff?
It says that they encourage banks to use this undrawn capacity. So the rest of the money you could borrow at the FHLB is part of their essentially liquidity stress tests. So stuff like LCR, this is really kind of the most constraining, one of the most constraining stress tests you get as a bank. And so in doing that, essentially saying, hey, you should consider the capacity there as part of the liquidity stress test. It may have taken the squish factor that allowed the NYDFS to put a Signature into receivership by saying hey, they actually did have the liquidity, versus the NYDFS essentially discounting that when they closed down that bank. So it's one of the ones where it's a little late for crypto right now, but it could potentially have stopped the NYDFS from putting them into the receivership when they had adequate liquidity.
So you've got assets on your balance sheet, you can swap them for cash at the FHLB, and you've got some amount of capacity you can do that for, and banks have to keep liquidity on hand. And so in the case, the example that I gave of Silvergate, they needed liquidity, so they posted assets at I think it was the FHLB, and they got cash. And now that cash was liquidity on their balance sheet. But then in that case, of course, it was called back, so then they lost the liquidity on their balance sheet. Is this saying that banks can consider their undrawn capacity as part of their liquidity? So it's sort of like they don't have to have posted it. They can just say, we have the ability to post this much and get this much liquidity. And so now we don't have to keep as much literal liquidity on our balance sheets.
Exactly. It does open an interesting kind of stress scenario setup, because when SVB went down, what the FHLB did is they changed their credit limit. So in a way, when you do take this undrawn capacity, there are events that could happen where that undrawn capacity now is decreased by a lot when your FHLB
relying
your credit
upon
limit.
It could change. Yeah.
But on the other side, it's pretty much a government-sponsored entity, so it's pretty much as good as a dollar.
Yeah, and the other point I wanted to make is whereas you were having to hold inert amounts of cash on your balance sheet, if you can now count, say, I'm making up a number, $100 billion, probably not that much, maybe $10 billion of undrawn capacity as effectively cash on your balance sheet. Well, what can you do now with the cash that you were holding on your balance sheet? What will banks do? Can they lend more? Can they buy assets?
Exactly. Hey, that's you free up liquidity there. You can lend more. You can do a little bit more credit creation. I did also kind of suggest here that Genius compliant stablecoins are supposed to be a big draw on bank deposits, and they can't really use FHLB loans right now as collateral. But that's potentially a change that could go into laws. This outflow we expect from banks stress could go right back into stablecoins, supporting it through purchasing FHLB loans. So there's an interesting dynamic here we can do to help. This is fostering credit creation at banks, and the things we suspect from stablecoins that may stymie it. We could perfectly pair the liquidity there to,
All right,
do positive things.
last nerdy bank and debt question, liquidity question. Can the banks, or will the banks, buy long dated treasury debt with that newfound liquidity? And if so, could that have been a reason why the Fed is loosening this? Right, they need buyers of debt.
Yeah, I think so, 100%. The short end of the curve is getting pretty competitive these days, and the Fed has talked about wanting to do some more long bonds. So absolutely, whether it's long T bills, whether it's more residential mortgages, it's just generally more cash flowing through the economy from banks. There, it's a positive thing.
It seems like the Fed sort of finally getting on board here with what has been a shifting political winds in favor of, a more clear, possibly more lenient, but definitely more clear approach to bank regulation that we're seeing out of the OCC and the entities that are actually addressable by the people, right? The Fed is not elected. So in that sense, feels like a positive. They're sort of following in the same, cleanup of Operation Choke Point 2.0 a little bit, which is great, since all we can do is beg, please, Mr. Fed, please do what the people want. All right, let's get to some quick hits. Let's start with Solana. A new inflation reduction proposal has been put forth by Helios, Solana development company and staking provider. There was previously one, SIMD 228, that was sort of a more dynamic way. Galaxy Research, I think led by Zach Picorni on this episode, had put out our own version of a way to reduce, which was more about the process by which to decide how much to reduce by. But now we have a new one. I don't know, maybe Zach, you can explain this one to us, at a high level.
Yeah, I mean, at a high level, they're just accelerating the disinflation rate of the Solana inflation curve. So instead of dropping off at 15% per year, it's going to now reduce by 30% per year until it reaches the terminal rate of 1.5%. So terminal rate doesn't change. Like, the lowest Solana inflation will go is 1.5%. They're just dictating how much faster we get to the terminal rate. And it kind of merges the approach of 228 in a way, with like the scope of our proposal, which was, let's also leave the 1.5% inflation rate. Like, there's really no issue with that. Let's just accelerate how quickly we get there. Ours included a more market driven way of deciding, like, oh, do we have a disinflation rate of 30, 40, 50, 100%? Or is it just a fixed rate dictated by the proposer themselves, which is what Mert ultimately ended up going with.
What is the benefit? What is the need? Clearly, now this will be the third. I mean, we didn't really push ours that far in a process of an upgrade proposal or governance proposal, but it clearly reducing Solana's inflation rate or increasing its disinflation rate, however you want to say it, pulling forward the lower inflation rate is clearly demanded. What is why? What is the big deal?
Yeah, I mean, I think there's a couple of reasons. Like, one, Solana as an asset and as a blockchain ecosystem is significantly more mature than it was when they created the inflation curve in the first place. Like, the whole point of inflation is to incentivize people to come and run nodes on your network to actually make it work. Whereas today you can launch a pretty lucrative business on Solana, and earn money essentially through that versus having to rely on the network for inflation incentive. So it's like, if we have a bunch of businesses on here who are making, I don't know, we'll call it like $750 million plus a year annualized, like, do we need to be printing that excess SOL to incentivize them to still be here? Like, they're running a good business. Like, let's let the validator be the loss leader, and incentivize better businesses. But there's also like a DeFi angle to this whole thing, where on-chain rates, like specifically around lending markets, are competing with the Solana inflation rate and the Solana staking mechanism as a whole. Like, Solana does not have the unbonding period that ETH has. Like, you can get your unstaked SOL pretty quick, and especially now that the network is much more performant and much more predictable, you know that at the end of every epoch, which is like consistently 2 days now, that you'll be able to get your SOL back. So lowering that sort of top tier, highly competitive rate, I think you can promote people to get into DeFi, reduce some of the frictions around that, and also maybe create novel collateral assets. Maybe something along the lines of like Athena's USDE or something else that's conducive to driving borrowing activity, and just making DeFi rates and lending specifically a bit more competitive.
Yeah, I mean, I think like overall for me, this is a pretty solid middle ground. Like it's not as drastic as the cut that would have come under 228. So it appeases, individuals who want the SOL inflation as they see that as an attractive aspect of holding the asset, while also appeasing those who really want to cut down on it. It provides a very like set schedule. So for validators, they can plan ahead in terms of how this is going to impact them. I think that was one of the concerns with kind of the dynamic rate that was proposed before. And then I think it has a pretty marginal impact on Solana validators as a whole, right? So the analysis that they provide in the proposal says that only 5% of validators will become unprofitable over the next 3 years. And so I think ultimately, like, the goal here is find a middle ground between the two parties. We saw a very contentious discussion last time with 228, and so far feedback seems to be generally positive. I would expect this to be. I don't know if it's going to pass or not. We've seen some people who were proponents last time now are opponents, and we've seen people who were opponents last time now become proponents. So it's very early, but it does seem to kind of find that middle ground that hopefully gets it passed. And I think hopefully if this does pass, this will be implemented over, I think, by midway through next year or so. So still need to go through the governance process. And I just want to say one other thing that we've been covering, I think, really well here at Galaxy Research is that the pace and kind of scope of developments that are happening on the Solana blockchain. And they're updating the tech stack, they're updating market microstructure, they're making applications are making tons of update in terms of how transactions happen or how swaps are done. And this really fits into that overhaul that's happening across the ecosystem. And for me, I think is often overlooked by observers. I would definitely encourage people to check out my Solana report that I published last month, which is kind of like I would call it my own Bible of what's going on Solana right now. Little self plug. But yeah, so I was happy to see it.
I always find it fun when crypto folks are essentially playing Fed, deciding what the terminal inflation rate should be to balance DApp usage versus staking amounts. It's a very fun turn. I mean, it is the business chain, so it makes sense. But I always find it a little entertaining.
Yeah. I wonder what Satoshi would think about chains altering their monetary economics. All right. Monad, a EVM compatible but parallelized executing blockchain, L1 blockchain, after a long time went live today on Monday, November 24th. What do we expect out of this chain? Is it going to be widely adopted? I know it's probably a little bit too early to say, but any initial thoughts on the launch?
I mean, my first thought is like patience. It takes a really long time to build an ecosystem and to kind of like have applications demonstrate that users want to use them and bring them in. So I'm not expecting any sort of fireworks right out the gate. I will say I was a little disappointed if you read kind of the blog post that the Monad team made just ahead of the launch, like highlighting what you can do on Monad. They literally highlighted trading memes, swapping coins, and perps. So, you kind of want to see like some sort of novel apps out the gate, ideally, to be like, oh, this is a differentiator for a high performance chain versus what exists. But yeah, I mean, I think most people are going to be using like what the market cap of the biggest meme on Monad is as the way to like evaluate how successful the chain launch has been. So we were talking earlier, like I think maybe in a week we'll see a meme in the 50 to 100 million range, which is quite a testament to how much the meme market overall has suffered over the past few months.
What, that would have been like 1 or 2 billion, you think, if it was a year ago?
I mean, yeah, probably in the 100 millions at least.
Yeah, and I think it's just a highly competitive landscape with general purpose chains, like as a whole, whether they be like ETH2s or something like Solana. Like the activity that's on there is like very difficult to kind of wedge out. Like we saw that between Ethereum and Solana. Like Solana, like one of the most widely used chains, struggling on the lending front, it all stayed on ETH. like now somebody's essentially going to have to dethrone like the spot trading stuff from Solana, which I think is a significant challenge because they have all of the distribution and just a couple years of momentum that would need to be kind of clawed back at. So I just think in general, like general purpose chains are just hyper competitive, and it's hard to kind of remove the activity from them when like it's just so sticky and people are not so quick to jump ship.
Yeah, are we oversaturated with this? I mean, we've got Plasma, we got a couple other L2s in the pipe. I mean, there's still plenty of ghost chains from last cycle already. Are we fully oversaturated, or there's some proper product market fits coming out of these? Do you think?
Well, are there also are there any? This has been long anticipated. It was a big project. It's got an interesting angle theoretically that it's an EVM compatible chain, but sort of with the parallelization that Solana uses. Are there others that we're waiting on now, though? I know some have launched, like you mentioned, Thad. What are we waiting on?
Mega ETH is the big one, which I think is planned for Q1 of 2026, and is also a high performance. But the only difference there is Mega ETH is a L2, while this is its own monad is an L1. But
And this,
yeah, I
Mega
mean,
ETH, their design is what? They're just like a super beefy sequencer,
a single sequencer, and
but like
actually
just like
very
giant, mega.
and very interesting. Like the founder has been like active in saying like he does not want to have more than one sequencer. Like he thinks that only brings down chain performance. He even criticized Hyperliquid for trying to introduce more validators and things like that. So it's quite the
Interesting.
difference from what we've seen in the past.
Centralization is the value proposition. All right, let's move on. Vector.fun acquired by Coinbase. I don't know, Lucas, you followed this. Vector.fun. What is that?
Vector.fun was a application on Solana. So the team actually first launched as Tensor, which was the leading NFT marketplace during the last cycle. Actually, a really impressive story. Like there's this other marketplace, Magic Eden, and they launched Tensor that had all the volume. Tensor launched and kind of like took over for a while. So the team has really impressed, I think, and showed that they're good at building these products. As memes became more popular and NFTs faded in popularity, they shifted to the meme side. So they launched this new product called Vector, which was basically like a meme coin trading terminal, but it also had kind of a social aspect to it. And that hadn't quite gotten the traction that Tensor, the NFT marketplace, did. It really struggled in a really competitive terminal environment. But last week there was some suspicious activity where the Tensor token, which had been down only for a long time, suddenly started ripping. People, I think at the time, were like, "Oh, short squeeze." We've been seeing these happen across the space with alts. And then on Friday, Coinbase came out and announced that they were acquiring Vector, and so the Vector team is going to be joining Coinbase, and they're not going to use the Vector front end, but Coinbase is basically integrating their back end software, I'm guessing, so token scanners, swapping, and things like that, and going to be adding it to, I think, the Coinbase app. But the controversy here is the Tensor token got left behind, and so there's a lot of people who hold the Tensor token that are very upset that they had been believers in the team. The team had explicitly in the past said that the Tensor token was related to the Vector product. And in the acquisition, Coinbase basically said, we're only acquiring Vector. The Tensor NFT marketplace will remain its own entity and product, and the Tensor token will remain with that product. Zach has something to say here.
Yeah, I mean, it's just like another case of like equity holders eat, and the founding team. I mean, a huge accomplishment for them, but every single person who bought their token is now just kind of forgotten. Like you still have the Tensor marketplace, but that was clearly the more unattractive product in the whole thing. And like part of the people behind the scenes win, and the token holder kind of gets left in the dust again. But I mean, I'm looking at the price of the Tensor token here. It's still kind of hovering like maybe 5x or so higher from where it was a few days ago. So I think maybe people are still speculating on something happening. Because like we saw with Padre and the pump acquisition, it was like, oh, we're not doing anything with the token. And then like 4 days later, they were like, oh, actually, like we'll essentially reimburse you from what it was worth when we made the announcement. So maybe some people are still speculating on that happening, but I have not seen any indication that will happen. And maybe that kind of comes along the lines of, oh, well, you still have the Tensor marketplace. Like we didn't take the whole product suite down. But net, like regardless, I think token holders lost out massively this entire deal, and equity holders obviously did well.
All right, before we get to what everyone's looking at for the rest of the week, I'm just going to list out a couple of other news items that happened last week that we've been following. The National Bank Regulator, the Office of the Comptroller of the Currency, OCC, says banks can hold certain cryptos to pay gas fees. I think they already could when Interpretive Letter 1179 came out, but and sort of the Biden era OCC guidances were repealed, but now they're being explicitly told. I guess banks just need to be told what to do. That's a theme in the Fed thing that you talked about, Thaddeus, right? Like they just need to be told exactly what to do by the government, you know. But that's positive. Kraken confidentially filed for an IPO. Trump's pick for the CFTC chair, Mike Seelig, cleared the Senate Ag Committee, and so we'll head to a confirmation vote, likely to be confirmed along party lines. And let's see. Oh, and the first public audit of Bitcoin Core, knock on wood, found no critical vulnerabilities. I think that's not a surprise to most who follow it. Bitcoin Core, probably the most transparent and audited open source code base probably in the world, but I guess had never formally been audited. Shout out to Brink for paying for that audit. All right, fellas, what are you looking at for the rest of the week here? Going into Thanksgiving, by the way.
Well, I've been looking at the evolving wrapped Bitcoin landscape. CBBTC really taking over share consistently. And there's also some interesting dynamics going on there with actually liquidation bots being a bit more efficient on CBBTC pairs than WBTC, and it leading to some interesting dynamics on chain. So taking a look into the relative efficiency of our bots this week.
Yeah, I'm paying attention to how much Mon is traded on Solana. I think that's like one part of the story that we didn't discuss is Solana has a big push into making it sort of like the hub of spot trading of all assets. Like I think that really kicked off with the whole Zcash thing. But it would be ironic if we see like a significant amount of Mon traded on Sol, and maybe it's competitive with how much Mon is traded on native dexes on the actual chain itself. So maybe it could be a redemption arc for Solana there, as it's kind of duking it out with Hyperliquid on the perps front.
Solana finds its way into every story, man. I would say I'm looking at I'm working on some stuff on X402 right now, which is this agentic to agentic payments, and they just crossed 50 million transactions over the weekend. So I wasn't at DevCon, but just looking at kind of Twitter and reports coming about it, it seems like that was a huge topic there. And I think it's one of the most exciting things happening in crypto right now.
All right, and how are you guys going to justify this price action to your families over Thanksgiving? I feel like Thanksgiving kind of is the Bitcoin holiday. It's like, you know, like every couple of years, like you're hated. Every other couple of years, hated for the price being down. Other years, you're hated because your family didn't buy when you told them to. Is it going to be tough for us out there?
I think we're at the place now, though, where Bitcoin has become so accepted that people are like, oh, like I should buy now, right? Like instead of being, you know, there was that old meme where it's like, where's our favorite Bitcoiner? Like, come on downstairs.
You know? There's our favorite Bitcoiner. How's your internet money doing?
Yeah, exactly. I think now it's going to be like, hey, this is a great opportunity, right? Which is a notable shift.
I think it means I'm not buying wine this Thanksgiving.
Yeah, I think people stopped asking me whether they should buy Bitcoin years ago. So I think they either did or didn't and got mad at me for either have or haven't buying. And so I'm hoping I don't hear anything about it. Okay. All right. Well, Thaddeus Pinikavich, Lucas Chayan, Zach Bacorny, thank you for joining. I'm Alex Thorne. Everyone have a great holiday, and we will see you next week.